Hello traders, Gary Wagner here, just about 11:15 in Honolulu, 4:15 in New York. It is Thursday, December 22nd, 2016, and this is the Daily Report for Gold and Silver. We do have a continuation of the pressure in gold, trading down moderately now on the day, off about $2.70 as we look at our continuous contract of COMEX futures to close at 1130.50. And that is a net loss of about $2.80, the low 28.60 and the high 35.50. Can you hear the silence? We are absolutely in pre-holiday sentiment in which we have seen the liquidity really contract as many traders have exited the trading pits and their trading rooms to begin a celebration of their respective holidays. Now, silver also traded lower on the day, but silver has been under more dramatic pressure recently, especially the last 2 days, than gold. Silver back below 16 at 15.85, a net drawdown of about 13 cents or 0.8%. Yesterday, gold lost about 2.5 and silver lost 0.75% in value. We're seeing the same occurrence today. So traders, as we approach this year's holiday season, I want to wish each and every one of you a blessed holiday season and a joyous new year. Tomorrow we will, of course, come out with a report, but it won't be, in essence, a live report, so to speak, something I do tomorrow morning. Rather, it will be the current Outlook 2017, Gold Outlook 2017, and 2016, a year in review. I am putting that together. I am shooting for the release of that, of course, before the end of the year, but I will give you at least the first half, a synopsis of what we're looking at tomorrow. I look forward to being able to share that with you. On to the markets. First market that I do want to look at or chart is silver, because we have noted that silver has absolutely been trading to a different drummer, so to speak, when compared with gold. We have seen this market come under pressure just as the entire complex has, as the U.S. dollar has gained strength. We've identified these channel lines with a bearish bias, and my sense is right now that we probably have a little bit lower to go, probably to the bottom of the channel line. But where I think it gets interesting is we definitely broke through the 61% retracement in silver, but silver did find a second set of legs, so to speak, and then came back up. This all the while gold was moving to lower pricing. However, when silver did start to sell, it got slammed in the market. Look at this one-day move, taking it from roughly just below 17 to about $16. 16 comes in right here. So quite a move, almost a dollar move that day. And so my sense is, if we see this market trade within this bias through the remainder of the year, I would expect it to find a bottom and support activity roughly at around 1550. That is our 75% retracement, and that of course is a retracement of the yearly range. Then the way that I have it plotted, you're looking at roughly $14, and I do have it up to this high below 21, rather than putting in this, what I believe is a high that was influenced by a lack of liquidity in the market and having players really move the market around, so to speak, and hunt for stops. Now, whereas when we looked at our daily silver chart, it was quite easy to see that the market had moved just slightly below the 61% retracement level, 61.8% retracement level, and kind of formed almost like a rounded bottom. It looked kind of like this in terms of the way that that bottom kind of formed, and then of course broke back above this particular price point at 1645, the 61.8% retracement. However, when we look at a weekly and we put in channel lines, you can see that the real bias in the market has been a long and protracted channel, and these little blips that we see do not amount to a whole lot when we view them through a weekly chart. Nonetheless, one of the things that I believe we will see is the market continuing to trade under pressure, and I would look to see at the 75 to 78% levels in terms of both gold and silver. I would look to find a little bit of stability in the market, and most importantly, we want to look to see if either of those markets are able to eke out some support. And traders, this is a chart that I am using quite extensively in the Outlook 217 and Review 2016, because now that the year has come to a conclusion, we can really take a broad-based look at gold, how it's traded over the last year, 5 years, and 10 years, and also from that postulate where we think it's going to go, and therefore be able to share with you my forecast model for next year, but by putting in the review, give you an idea of what techniques I have grounded these studies and these observations from. This is a very long-term chart. Each bar represents 1 month of trading. I've got a couple of fib retracements. The primary ones, one begins at about 700, and that's after the market had reached 1,000 for the first time in history and then retraced about 300. So we had roughly a 30% retracement, and from there it ran to 1920, but that was very, very short-lived because the real tops come in at roughly 18. So on this fib retracement, you can see the dashed lines here and the dashed lines here, and they represent the low and the high for this particular fib retracement. And the number that we want to look at in terms of the fib study has got to be our 61% retracement, because in essence what we are saying is that we had a long, protracted, one of the most profitable rallies I've personally witnessed, but I know that my subscribers have witnessed, which began roughly at 208. We opened our doors with the gold forecast kind of right here because I believe that we were going to see an unprecedented move in the market. We absolutely did. We had that high of 1900. As I said, that was short-lived. It sold off, but when it sold off even more dramatically. Look at this intra-month low, but we did find a ceiling at that point at $18. And so by putting that number in, the key is, and this is something we talked about really last year also, is that as this market came down and it tested these new 5-year lows in gold at about 1440, there was still a case that could be made for a bullish model, and that would be under the assumption that we had a dynamic rally, and then from really 2011 to the beginning of 2016 or the conclusion of 2015, we had a long extended correction. And in terms of then our Elliott wave model, that predicated that we had completed a corrective A wave, and that is immediately following this major fifth that took gold to a new all-time record high. Now, what I talk about in the review, the 2016 review, is we had some pretty good warning signs, and we had some excellent trades that we executed. The first one, I believe, was January 8th, and then we put on a couple of more positions in gold, and we really profited as this market ran up. But here's one of the interesting things. If we look at this fib retracement level, which is from the high to the low that was achieved on this most recent strong multi-year correction, and we plot a 38% retracement of that range, that matches up precisely to the highs achieved this year. And I think that that is something that's absolutely noteworthy. Now, from there, once we hit about July, we hit the top 1380, we began to sell off, and now the question is whether or not we are going to hold various levels, because this is a 78% retracement. Now that's a retracement of this entire rally here, the short-term rally, but what's most interesting is the harmonics. The 78% retracement is pretty much on par with a 61% retracement of this big move. And that is something that tells me that where these markets fell to and found support, or traded up to and found resistance, are all coded with those Fibonacci sequence numbers in them. and the fact that we see the market hitting tops that are precisely at a distinct relationship. Here it's a 61% retracement, and that's of this particular level right here. And so, and a 38% retracement, we absolutely get a harmonics at this level. We absolutely get, which is the high of the year, we're absolutely getting a harmonics at around 1100, and that is where I believe traders, gold prices are headed to. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review, but hopefully I will have finished our Outlook 2017 and Gold in Review 2016. We'll talk to you then. Bye-bye.